Hi everyone, welcome on Money A. I am Mark, and today I will talk about CE Brands, a company that leveraged artificial intelligence to identify gaps in the consumer electronics market. To talk about the company, I will be with Craig Smith, CEO and founder of the company. How are you, Craig?
Really good. Thanks, Mark. Thanks for having me on.
This is my pleasure. Could you talk more about and bring more awareness about the company? What's the story behind it?
Well, CE Brands really is the genesis of a culmination of a few different companies, eBuy Now and Sonatic out of Hong Kong and Vietnam. And really, what happened was about 6 years ago, we created this AI data mining tool called Product Loop. And what Product Loop does is it fundamentally mines data of consumer electronics products sold around the world. And what we do with that data is we look for sales velocity, we look for customer sentiment, and we look for opportunities in the market. So really what we've done is we've built a company around making good decisions on data, and that'll be our future. It's really around entering into markets that have high growth, and where we can see there's an opportunity because customer sentiment is saying, hey, if you fix this problem, it's likely that you will satisfy more customers. So that was really the genesis of CE Brands. The reason we went public was because we have some very high and lofty aspirations with the company. We want to be in many categories in the next 5 years, and that's going to take huge growth in product purchasing and reach to 70 countries which we distribute into. So that's really the main reason we went behind the public offering, and that was the genesis of CE Brand.
Okay, and right now, in how many countries you are located in? Who are your biggest partners?
Well, those are two questions. So we've had a phenomenal 6 months, really, since we went public. We've signed over 30 distribution and retail contracts since we went public. And it's getting faster. It's like things are really heating up. Since we launched the Motorola watch, there's been a huge uptake in distributors and retailers from North America and around the world, especially in LATAM. North America, we've picked up some really good partners. So today we actually sell products in over 70 countries directly to end users, and we have distributors around the world. We try and match distributors with the brand. So right now we have a set of distributors that manage the Kodak brand, and we have a set of distributors that manage the Moto brand. And as we introduce new brands, we'll introduce new distribution partners into those portfolios. But when you say the word "who's your biggest," we're trying to avoid being locked into one brand,
Okay.
one category, one product, one country. We have the ability, because we have quite a small nucleus of a company that has a highly repeatable process. We're trying to leverage that horizontally. So we look at three main tiers or peers to do horizontal integration. One is manufacturing, one is brand, and one is distribution. So it's a job of mine and the executive team to make sure that we can have a very flat reach to as many manufacturers with as many brands and as many distributors as we can, because then you're not at risk, as a friend of mine once said, of having one phone call that can ruin your day. And I think we've done a pretty good job of that. You know, if you look at the portfolio of retailers, products, distributors, brands, we've done a good job of doing that horizontal approach, rather than going after just having one major brand, one major retailer, one major product that dictates our forecasts.
Okay, so basically the fact that you have many distributors, you don't depend just from one. That's it.
Exactly.
Okay.
And if you look at the types of manufacturers that we've been able to deal with, Compal, Luxshare, Ioni, these are major manufacturers. So our message and what we do appeals to the largest manufacturers, the peers of the game right now for consumer electronics. And we rightfully speaking, we've just started. So, being very frank with you, we have no rights dealing with these huge multi-billion-dollar companies. But our message of what we're trying to do by using data to drive good product decisions has really resounded with these factories. So we've managed to sign long-term agreements with some of the biggest players, and that's our future. Our future is to take the data, take it to the leading manufacturer in that category, share the data with them, and then together build good product, better product, because we're taking market information about what customers are unhappy about and what they're happy about, and we're creating the product requirements document out of that information. And so the factories really enjoy getting real-time market information. So we're building on that process to get more factories as we go through. So in the next 5 years, we're looking to be in multiple product categories eventually, and that's going to require multiple factory relationships.
Okay, I understand. It's definitely like an healthy growth. You grow like on every part, I would say, of the overall project.
Yeah.
I don't understand like the image, and okay. And so you were listed, like you say, pretty recently. So in 2021, have you faced any challenges for the last year?
Oh, for sure. Yeah. One of the biggest challenges we faced, really, or I'd say the two biggest challenges we faced, has been on procurement and manufacturing. We really entered into a difficult time. As a company, we've been dealing with that and with bringing in the right people to create this highly repeatable business model. And I think we go into 2022 a lot stronger because we've put some key executives in place that deal, especially around China, Hong Kong, Vietnam, that have been able to create repeatable process around ordering. But I'd say one of the biggest changes and issues we had in 2021 was the lack of a combination of forecasts from our distributors and then therefore from ourselves to the factories that allows them to place long-term lead orders. Why that was an issue is that you end up buying spot rate products on the market, and that gets costly because right now there's a lack of chipsets, shipping's been an issue, there's a lack of LCD. So the major change that we've done from 2021 going into 2022 is we've done a much better job of doing long-term forecasts with our distributors and retailers, that now it's completely understood to place 12, 18-month orders. And that helps us because then we can go back to the factories and we can place long lead forecasts with the factories. And that secures the pricing, it secures the delivery date, etc. So I don't think that's just for our company. I think that's going to be a new standard for most manufacturing distribution relationships.
Okay.
That's why I feel far more confident about 2022 and our roadmap, because 2021 was all about getting up to speed, getting the orders in and getting the forecasts in. So we've come a long way in 6 months since going public. We have a long way still to go as we grow our business, but we've put the right people in the organization now to manage that.
Okay, so it's like if I would say the year 2021 was sort of the construction phase where you had to put all the right tools for the foundations. That's
exactly. I mean, on top of that, we had some challenges with supply chain. This is very well known. It's about how you react to those challenges. So the way we reacted was to make sure that our forecasting was more secure, that we sat down and had good discussions with our distributors, and we had people who were very, very 20-year plus experience in manufacturing and order processing. We've put these kind of people in the company now to help us grow to the next level.
Okay. And as you were talking about costs, expenses, for your business, what are your biggest expenses?
I think it really comes into three key areas. Ultimately, we still manufacture products. We're using data to make better decisions, and that gives us a competitive edge. But we're still a manufacturer and a distributor of products. And really, there's three key phases with that. You get the initial development phase of designing and developing a product out. One of the tools we have is the reason we did this merge buyout with Synatic 3 years ago was that they had an engineering team already in place. So R&D, engineering, apps, server, authentication server already set. So that is a cost, a very high cost for most businesses when you're building from the ground up. Well, we've acquired that in, and that cost diminishes over time because the more products you sell, that team, that nucleus doesn't need to expand with the rest of the business. So that's been a heavy cost at the beginning, but that will bear fruit, especially as we now going into a phase this year as we're shipping more products. The second phase is really as you distribute to multiple countries around the world and distributors, you're going to need more cash for the goods. So there's credit terms in place, and so we've done bank financing with companies like CMC. We've gone to the market again and we've raised debt financing, and that was again to help us through this phase right now because our order books are very strong, especially around the motor product line for this year. And so, any product business is a cash hungry business. And the third area is obviously operations and staff. I mean, as I've just said, we've put the right executives in place now to manage the growth of the business. But as you're a seed and you're growing up to the next phase and you start shipping your products, that's a cost on the business itself. So all of those costs, well, really the development cost and the operation costs, we should see that having far less impact on our EBITDA by the end of this year as our turnover grows exponentially, because we don't need to grow the staff and the development team, in direct relation to our sales. So we're seeing much stronger margins coming out at the end of this year.
Okay. And we're talking a lot about cost, expenses, but I saw when I was doing my research is that your company and your board did a lot of actions to compensate. Could you talk more about it?
Yeah, sure. I mean, we went to the market, and what we wanted to do is focus all of our energy on product. I mean, we have extremely robust order books right now, and in that position where you have robust order books, you want to make sure that all the money that you borrow or you take in under equity is used exactly in the right area, so you quickly get to a profitable situation. So what the board and the executive did was that we decided unilaterally to take a reduction in pay in this period. So we could handle all these orders coming in, and any money we took in from the market, we obviously wanted to keep the equity asked to a minimum and use the debt pieces we come in for stock. So that was a unilateral decision. We cut G&A down dramatically. I think we cut it 40% in the end. And that's had a big effect on the business to go profitable, because everybody wants to see that, including us internally. And we want to use whatever money comes in a very fit for purpose way. So that was what we did.
Okay, this is very interesting, because sometimes you can see some companies, even if they are, I would say, short on money, you would see the board still having not taking actions like you did. So this is very smart. As an investor, I would definitely look at this type of management who is focusing first on the products and to make sure that all the products will be available, like researches, this type of thing. And
with that in mind, Mark, it's because we have such a clear strategy as a company to take this data and use it, and the reactions we've had from factories, from distributors, from retailers, from the brands has been so strong that the momentum and the desire in the company is really strong to make this work. So it wasn't that hard an ask, to be honest with you. Everyone can see what we're trying to do. Everyone can see the path that we're on. So it was almost like a no-brainer. Like everyone knows what we're trying to do. Let's get to fiscal year 2023. Let's get profitable, and let's grow this business fast, because we have a great opportunity right now. So it wasn't a hard decision internally to make.
Okay. And as you say, you did a financing in November, and you did a debt financing and equity financing. That's it. How much did you raise for the whole?
We raised $5.4 million. $1.4 million of that was equity, and that was specifically to manage G&A. We wanted a long-term G&A coverage. So we
Okay.
took the 1.4 as equity for G&A only, and that was part of the discussion. But look, let's give ourselves a long runway for G&A. And the 4 million with an option of extra 2 million is going to be used for product and purchases. Right now, our order book's extremely robust. Every day we seem to be getting better news and good news from the salespeople, which is great. But you need cash in that process.
Mhm.
So we're working on multiple angles with the banks, with debt lenders or debt facilities, not just for now. We're covered, absolutely covered for this period now, but we're seeing this hockey stick coming. So every tool at our disposal needs to use factory credit, financing of the invoices to the distributors and to the retailers. All those levers are being pulled right now, but it's a good problem to have. Our problem is our growth is already starting to show on us, and we have to be very cognizant of what's happening in Q2, Q3, and Q4 because there are big orders in the pipeline.
Okay. And I know this is like a pure like question for management, but as a retailer, I was wondering why did you do both? First, you did debt and equity financing.
Um, as I said, we wanted to use the debt purely for product, and
Hmm.
we wanted to use the equity purely for G&A. So what we did is we made a decision on what are our overheads, so we can give the financing department a very clear understanding of this is what we want to use this money for to cover the operations of the company for the long term, and this money here for debt we want to cover with stock.
Okay.
So we put ourselves in a strong position now that we can certainly get through the period we're going through, and we can handle all the orders that are coming in now. So we're in a strong position.
Okay. And so now, if we focus on your current balance sheet, how is your balance sheet? So if we talk about total cash, debt, options, warrants.
At the moment, we've got 25 million outstanding shares. If you look at our balance sheet, we're healthy from a cash position, and if you look at our debt position for stock, we're healthy. We can certainly afford all the orders that are coming through right now. And the good news is that after Chinese New Year, we're starting to see some movements from the major manufacturers to push us to even better credit terms. So this has been great work from the Hong Kong team, and that's the benefit of bringing in these high caliber executives that can then do these types of negotiations. So from a health position of the company, we're healthy. From a share price, I think we're very undervalued right now from a
Hmm.
share price. But that's because I'm looking at the peers and the comps out there, and what our plans is. But I think what the market wants to see and what they rightfully have asked for is they want to see some good quarters. They want to see us on the right trajectory. They want to see our profit margin and certainly our EBIT going up. And that's what we're all focused on right now, especially for the next 2 quarters. Our job is to make sure we drive those sales, drive the profit margins, and post 2 very good quarters. So that's where all the focus on the business is right now. And I truly believe that once we get through these next 2 quarters and drive those numbers and people start to see it, I think towards the end of the year, people are going to see this machine in action, and they're going to see more and more products and brands coming out, and they're going to understand how this is a production line, that we've created something that, now we've got the core running, that people will see the value in the business as the fact we can just keep repeating out new products and new distribution agreements. So that's where the value in the company comes from, and why we believe at the moment the share price is very, very undervalued.
Okay. And for sure, like when you were taking a look at the overall stock market, a lot of companies saw a decrease in price, more especially the emerging companies. So, like when you say you are at the very beginning of the hockey stick for the year 2022, it's just a question of time, when investor will see the quarters,
For sure.
numbers talk better than, like speech.
Yeah,
So,
and Mark, to be honest with you, we've missed 2 quarters against what we projected because of the delivery. So it's on us as well. It's our fault. And we should never have done that. But it was where we were in the market. We are very confident now what's going on. So I understand the market. They generally go with what you're telling them, and It's our job to make sure that we hit our numbers and we start posting good quarters. That's basically what it comes down to. So
Mhm.
this year is a real year for us to start doing that. We can see our order books. We know what's going on. So we're very confident about this year coming up. And then hopefully by this time next year, we're having a whole different conversation about how we expand the business with new brands, new products, etc. And we can talk about the machine a bit more about how we replicate this over and over again.
Mhm. And so for the year 2022, as you say, is where we're gonna see everything. Um, so what revenue do you target for the first quarter and for the whole year?
Well, we've posted $50 million as our target for the year. You know, as a valuation, that puts us very undervalued.
Mhm.
We are very confident on that number because we're already seeing what's happening with the watch launches that we've done. We've got a new security camera out. We've got a new air purifier out. So we're getting the orders in for those now, and they're starting to ship. And the ramp is quite quite exceptional. So we're comfortable with the numbers that we've posted already. We feel that we will match them. You know, and once the market sees those numbers, I think we'll start seeing a lot more faith and value in the stock price that we have now, and we'll start to see an increase in the stock price coming quite rapidly.
Okay. And you were just talking about products, incoming products on the market. So how many products will you target for the next years?
For the next years,
Mhm.
multiple years.
Let's say just the year 2022, and after like let's give us a scope in 5 years.
Okay, so I'll work backwards if you don't mind. The consumer electronics business in 2020 was worth $1 trillion. The consumer electronics business in 2027 is estimated to be worth 1.5 trillion dollars. That's a 50% increase in this 7 year span. So we are in a perfect time to be creating this vehicle where the products are very important to us. We try and hire the best product managers to manage the product groups that we have. And we have this engine, this secret sauce, if you like, that's telling us what the market's asking for, the value and the sentiment. So it's our objective to be a major player in many CE categories
Okay.
in the next 5 years. So, you know, I don't want to give too many specifics because of future looking, but I mean, we've put out there that we're looking to do 192 categories within the first 5 years of going public. You know, that would make our company huge in a valuation and in a
Mhm.
turnover. Where we are this year, we've already announced that we've got 4 products launching immediately. We've got another two watch products coming out middle of the year. I would expect to have 8 products coming out this year with the company, and I would expect to have another license or 2 licenses, certainly one more, which we will announce. Taking us into new product categories through this year. So the job of the company, especially myself and the product team out there, is to sign new licenses, bring in new categories, bring
Okay.
in new revenue streams, and create this repeatable process. So I think we've already announced the products that we're launching. We've got the smartwatches coming out. We've got the security cameras coming out. There'll be a range of products under that security line. We've got some new health smartwatches coming out, fitness watches coming out. So and with the air purifier range expanding, you'll start to see more products coming into our portfolio, and imminently we'll announce some new categories we're entering into with some new licenses that we're taking on.
Okay. And so just if we jump back on the stock part, I would say right now you are only trading on the Canadian exchange, right? And
Yeah,
will you plan in the future to be trading on other exchanges?
absolutely. I
Yeah.
mean, look, the whole objective of the company, candidly, is to be listed on the Hong Kong Stock Exchange. If you think this story resonates well in Canada, we fundamentally take leading manufacturers from around the world, and generally those leading manufacturers are in China, in Taiwan, in Vietnam. So our story resonates incredibly well. out of Asia. So to be based on a predominant Asian stock exchange is where we want to be eventually. Because when I go and see factories, when the product team goes and see factories, and we show them the data we have, and we show them the process we have, there is just such an overwhelming response that they understand what we're doing, they understand that the path that we're on, and they want to be involved with us. So the fact is, that's a good place for us to gravitate towards, and then eventually we'll go into the US and Europe. But at the moment, our focus is quite laser on getting into the Asian stock market.
Okay, step by step, right?
Yeah.
Even if there's, I can see like a lot to do and a lot like to expand. Like so, I would say so many possibilities. Sorry, of expansion. Okay, I totally see. And we talked a lot about the company, but this is really like your baby as you founded it. So, what motivation is driving you to accomplish the whole C brand project?
Good question. Look, I think anyone who's been in this business, I've been in this business for 25 years plus, and obviously I have a lot of friends, peers in the business that I've worked with, and what we're doing now by using data to drive decisions is been a holy grail for a long time. Just seeing the reaction, and if anyone wants to investigate some of these companies that we're working with, you'll see that these are peer manufacturers. So being finally in a part of my career where I can work with the best manufacturers, the best distributors, get into these really tier one retailers on a global scale, not just North America, but in Europe, etc. That's a very proud thing for anyone who's been in the industry. So where I'd like to be is as we mentioned before, in 5 years' time, I want to be sitting in the middle of a group who's dedicated to making a highly repeatable process that uses data to drive the decisions, and we focus and keep investing in the core of the company, which is product loop, that helps us create this business model that really is the production line of the data that comes out that helps us get in the market and make better products. I've already seen with my own eyes how much this resonates with the companies that we're working with. So it's just now making that as industrial as we can, and I want to be part of that. I want to see that come to full fruition.
Okay. Well, it was very interesting. Thank you for first talking about the whole, I would say, project, what's behind CE brand, and after to talk more about, I would say, the personal side. So I'm very excited to see for the next quarter and this upcoming year what CE brand will be at. So thank you again for your time.
Thanks, Mark. I appreciate it. Thanks for your time.